What it do? Cashlight Green back with another video. This one we about to just basically be talking about this market crash that's going on. I got a couple different posts, some stuff I want to pull up on my Excel sheet that's looking kind of good. I'm about to get some braids in a few, so combing out that hair. Anyway though, to start spitting the facts on what's going on in this market, I want to pull up one quick thing that I seen that's explained it very, very, very well. And I'm gonna basically have to get in my messages. Here we go. All right. So I want to pull this lady up.
Wall Street Girly, who breaks down confusing finance topics for you. For a long time, borrowing money in Japan was cheap, like negative rates cheap, meaning banks would pay you to borrow money. This made Japan very popular for carry trades, aka investors borrow money from cheap borrowing countries to convert it and then invest in expensive borrowing countries where the returns are higher, aka America. But recently the Bank of Japan was like, ugh, the yen keeps devaluing. So BOJ Daddy raises rates. But because US Fed Daddy didn't raise rates this summer, the yen got a lot stronger versus the USD. This put carry trade investors in a pickle. Not only was the BOJ charging interest on those loans now, the yen had surged and investors were getting hit with margin calls, aka the banks calling them like, yo broke boys, prove to us you can actually pay these loans back. And these investors were like, I don't got it. So they had to sell US stock, leading to downward movement in the market to buy yen and fulfill their margin calls. But overall, if you're a regular investor, none of this should matter to you. Just invest in a diversified portfolio over the long haul and you'll weather the ups and downs. So what's going on in Japan and why did it hit America like a...
Wow. So she came in with some great heat and some information. As you see, this was one of our biggest trade on paper months where we did like pretty much would have put out the 8,700 or between the 87 and would have got like 8,000. But if you want to look at these calls that we just did, right, the ones that we had just closed out, if you look now, they're all down 28 points, meaning that all of these stocks are down. You feel me? All of them are down. All of them are down. These, I'll just pull up Ferg, right? For Ferg specifically, that one dropped like 20 points pretty much. So, oh yeah, and I want to pull up one more stock before one more post before I digress. So right here, right? This is key. You feel me? Retail traders are liquidating when the market is down. So that's like my account being down. What? That's like my account being down 1,300, and then me selling off my options trades while the market is down. So investors are adding to their portfolio, meaning that they know that the feds are going to cut rates, leading to more free money, meaning that they're going to reinvest into their companies to buy back more stocks to keep the prices surging up, which is going to cause an even bigger bubble that we're in for maybe next year. So it's not going to hit, it might hit like December to March, but if it doesn't hit between December and March, it's definitely going to be next October for sure, when everything is just hitting the ceiling, because there's already no money in the system, but they're going to print more money to inflate stocks and assets, which makes no sense at all. It's just causing for a recession, literally a depression, really. So as you see, right, we traded up, down. Then we got back right. That's when we sold right here. Remember when we sold? When we was like, man, we just gonna take profit and kick to the next plays. Boom. If we would have kept them plays, niggas would have been down. Basically, this was the whole profit. So we cashed in here 27, and now we're down 38. So we would have lost all of this and all of this. So that would have been 3 and then 4. That would have been 7,000. That would have been my whole entire account on one play. On one play. You feel me? Just by not following what we were supposed to do. And we didn't even catch the peak here because we didn't even sell when our alarms was going off. So the key thing here, you feel me, is to always look at your past plays. Yes, when the market is doing good, the market is doing great. It's doing fantastic. Everything is going up. You feel me? Stuff gonna pull and it's gonna pop. It's gonna pull and pop. So what's really key here is this new Fed rate that we finna get out. If we get an emergency cut, you could definitely expect to see this do something around like this right here. Where we at with it? Where we at? If it does this, you can definitely expect something like this. You feel me? It's already down 25. You can definitely expect something like this. You feel me? Within the next 2 to 3 weeks. A lot of my all of my contracts don't expire until the 20th. So of next month in September. So we have more than enough times to honor these agreements and to get these contracts where we need them to be. But just to pull back up what I was going to say as far as our Ferg play, right? Our Ferg, check me out on the Ferg. It's at 169, you dig? Ferg at the 169. Ferg at the 169. And then look, check it out. Check it out, right? Ferg at the 169. We seen the play at 190. You feel me? We seen the play at 190. It had got all the way up, bro. It had got all the way up to 218. Then it bounced, you feel me? Back to the 190. So we would have hit right here, and then we would have been down. Let's check Sherman. Sherman, right? Let's check Sherman, right? Sherman, we would have got Sherman at 297, basically right here. We would have got Sherman right here at the 297, and then if we would have held the contract until today, when it expires next week, we would have been down basically $1,000. You feel me? And then let's go to DHI. DHI, right? DHI 169. So that would have been another 8 points. That would have been a rack, 1,800, and then like 1,900, 2 racks. That would have been 4,000 right there. That would have been 4,000 on these, and I'm pretty sure these those losses got bigger for sure. So, oh no, it actually recouped. Ooh, okay, that's what we like to see for sure. It recouped. Dash recouped too. Dash had recouped. MPC. So when on these recoups, that's what I'm saying. You gotta just set it out long enough. MPC didn't recoup, but it didn't press down no further than what it was. That's cool. AME dropped crazy. Damn near 19 points. You feel me? That would have messed us up. So that would have been 2 racks. That would have been 4, 2. That would have been 6. Then we would have hit on this one. That one would have went up like. So we would have basically be at like right here. If we would have kept in positions, it would have been right here, as opposed to selling out around like right here. These days right here, right between in there. So from 87 to 64, we would have cashed in probably like 7,000, as opposed to holding the contracts out and only walking away with like 3. You feel me? Same thing we did here. You feel me? Cancel them out. Then we would have expected just a week later, just 7 days later, bro, all our profit would have been negative $2,800. That's ridiculous. It's ridiculous, bro. Ridiculous. So for these right here, they pop, then drop. Pop, drop. Cool. So pop, drop. So we're probably gonna be expecting like 2 weeks of drops. 2 weeks of drops. That's cool. As long as the contracts don't expire, we pretty much good. As you can see, right, we down. This is the main one right here. This one is done. This one's done. I'm gonna try to get out of this sale immediately. Down like, I'm 28 points down, so I'm down like a band on that one. So yeah, the Ferg, the Hubble is the one that's gonna pop, and the AMAT, Applied Materials, is gonna pop. But I'm gonna cut this live right here, and we are going ham on the market this week. No cap.